Hey everyone, it's Rayce Robinson. Hope you're having a great day. I thought I would kind of answer a lot of the common questions I get on credit reporting. I probably look at hundreds of credit reports every month. And in reality, I don't know almost anybody that's not been affected with the economic turndown, with the short sales, foreclosures, and bankruptcies, and kind of record numbers for the last 3 or 4 years. If you haven't been affected, you're definitely one of the lucky ones. So one of the common questions I get is, when is a late payment? Well, you're not late till 30 days late. So just keep that in mind. A lot of people think, for instance, on a mortgage where it's due on the 1st, you actually have all the way until the end of that month before it's considered a late payment. We recently had one of the biggest credit reporting agencies come and do a presentation, and I was surprised by how much even people in the industry were wrong on some of the things that we just kind of take for granted. So here's some of the things that I learned. One thing is the credit mix. A lot of people don't realize what actually affects their score. Basically, it's payment history and amount owed are the biggest two things. And then there's other little factors like your credit mix and length of history and new accounts. One of the things that people make a mistake on is they look at a ratio of available credit versus what you have used. So if I have $5,000 worth of credit used and $20,000 available, that's better than having $5,000 of credit used and $5,000 available. So one of the mistakes is closing credit card accounts that are open, even if you're not using them, because it affects your available credit ratio. And that's a big one. That's almost 35%. One of the things that makes a difference on your credit score that a lot of people don't realize is the industry looking at it. And I had no idea about this. So if I pull your credit, I may get one score. If you go to freecreditreport.com, you'll probably get a different score. If somebody was pulling your credit for a car or a credit card, it's going to be different. Each industry has a model on how they weight different things. Obviously, in the housing industry, a foreclosure or short sale is a bigger deal than, say, getting a credit card, where maybe charging off a bunch of credit cards has bigger impact. So keep in mind, the industry looking at it makes a big difference. And then last are the inquiries. Inquiries don't really affect your credit score. That's kind of a myth. Your credit is designed to be used. So keep that in mind. You don't want to have 100 credit pulls. And if you have an inquiry here and there, that's what it's designed to do. So, okay, so the biggest questions I get, I would say loan modification. Loan modification affects your credit. One of the things with loan modification is typically, a lot of times you actually have to get behind on your scores or your credit or your monthly payments to get a loan modification, and that will drive your score down. The modification itself is not a huge factor on you, say, buying a house in the future. We just have to look at the modification, how long it's modified for, and if it would affect your ratios later on if your payment were to go up. Those are the things that we're looking at. So a loan modification, especially, and I have seen these where you don't have to get behind on your payments, is probably the least impact on your score. Probably the big question I always get are short sales. Unfortunately, a short sale is looked at by banks, lenders, really everyone in the mortgage industry as a foreclosure. It doesn't really affect your score as much as a foreclosure, but it definitely keeps you from buying a house. So rule of thumb, and this changes, I'm not going to get into this video, but basically, if you had a short sale, you're 2 to 3 years out from buying a house. 2 years, you probably have to put 20% down, 3 years to go FHA. So if you've done a short sale, you're at least 2 to 3 years out. If you do a foreclosure, you're definitely 3 years out. And then a bankruptcy with the foreclosure, you're 3 years out. And again, different factors affect these different ways. So, something that you'd have to call for a specific scenario, because for every rule of thumb, there's a way to get around it. It just depends on the situation. Basically, some things that I wrote down that were kind of interesting when they came in, a lot of people don't realize, like a 30-day late payment can bring your, so you must have one late payment can affect your score almost by 80 points. Debt settlement, 140 points. And foreclosure and bankruptcy, 150 to 250 points. So, the bigger the event. And strangely enough, the higher your credit score is, so if you had a 780, you're going to have a lot bigger hit on your credit as opposed to if you had a 680. That actually doesn't make sense to me, because you've had great credit in one bad event. It seems like it would be the opposite, but I don't make the credit scoring model. So the higher your score, the bigger the impact. So with that, those are some of the big questions that I get asked. If you have a specific question about your credit, definitely give me a call. We do have what I call a mortgage credit repair company that's really inexpensive if you want a professional to help you actually maybe eliminate things off your credit or actually negotiate some things down. There's a lot of things that you can do if you have a professional involved. You just don't want to overpay. I see some of these credit repair companies charging a fortune. So we have a really good one that's not expensive. And if you're interested, give me a call. So with that, have a great day. Remember, call me for any questions about this or any mortgage needs that you have. And with that, make it a great day, and I'll talk to you soon.